Hey guys, what's going on? I am back with part 2 of your stock picks for the month of July 2018. I won't bore you with an intro for this video, so let's just jump straight into it. And the first stock we're going to be looking at today is Air Products and Chemicals. They are the world's largest supplier of hydrogen and helium gases, and they also provide products and services in a range of different industries such as energy, electronics, chemicals, metals, and manufacturing. They currently have a market capitalization of 35 billion, a PE ratio of 26, and they're currently paying a dividend yield of 2.5%. I didn't go too in depth with this company because when we have a look at the revenues and the EPS, or the revenues and the net income, over the last 10 years, both of these numbers have been declining. When a company has declining revenues and earnings over 10 years, it's very difficult to predict when they're going to start growing and by how much they're going to start growing. When I talk about these companies and I say that I didn't look any further because their revenues were declining or they weren't growing quick enough, it's not necessarily because I think they're bad companies or that they're definitely not going to be higher in the future, like that I'm betting against them or anything. It's just that they're not predictable enough, or the numbers aren't uniform and they aren't growing consistently enough for me to be confident in using the old growth numbers. And especially for a company like Air Chemicals, their long-term growth rate is negative, especially for the revenues and the incomes. So it's very difficult for me to take those numbers and then come up with some sort of positive growth number that will get us our 15% returns per year. If we have a look at the earnings per share, we can see that it was big this year. However, I like to look into the income statement when we see a really big jump in the earnings, and we can see that this was mainly due to net income from discontinued operations rather than from internal growth. So the next stock we've got is Starbucks Corporation, and this is one of the stocks that I think looks very promising and that I had a little bit of a longer look into the numbers to see if there was something there or see if the numbers were consistent enough that we can predict future growth in this company. Starbucks has a global chain of almost 30,000 company-owned and licensed stores. They currently have a market capitalization of 70 billion, a PE ratio of 22, and a dividend yield of 2.24%. After having a quick glance at Starbucks numbers, I could see that over the long term, they'd been growing quite quickly. So I put these numbers into my spreadsheet so that I could calculate the growth rates over each period of time. As we can see, over the long term, the growth rates have been very good. Equity and sales just under our 10% requirement, and earnings per share and free cash flow at 30% each per year over 9 years, which is amazing. However, over time, these numbers have gotten worse. Earnings growth has been slipping from 28% to 18% to 17% to 13% to under 4% this year. And while this is normal for a company growing at such a high rate in the past, it needs to be trending upward for us to be able to accurately predict a future growth rate. Overall, I would say the numbers are good. However, the fact that they're trending down makes it really difficult to use the old numbers and be confident in using the long-term numbers when predicting growth. Because when they're trending up, the smallest numbers is our long-term numbers, and it's also the long-term performance of a company, which means that we can be confident in using those numbers. However, when the long-term performance of a company is the best that they've had in the past 10 years, and in the past few years it's been getting worse and worse, it gives us an impression that maybe over the next 5 or 10 years, it's going to get even worse, and that's not a company that I want to be investing in. So next we have a company called Axon Enterprises, and I hadn't heard of this company before, but what they do is they offer devices, apps, and the people that will help law enforcement become safer and smarter with products such as body cams and smart weapons and evidence management cloud. They currently have a market capitalization of 4 billion. They have a PE ratio of 270, and they currently don't pay a dividend. I had a bit of a look into this company, and I think what they're doing is really interesting. However, when we look at their financials, they just haven't been profitable long enough for us to be able to predict their sustainable long-term earnings power. And even if we look at the 5 years of earnings that they've had, they haven't been able to grow their earnings consistently over these 5 years. It's not like every single year they've been growing at between 10 and 20%. So it means that even in the years that they've been profitable, they haven't shown us what kind of earnings power they have and what kind of consistent earnings power we can expect to see over the next 10 years. Our third stock today is JD.com, which is the second largest e-commerce platform after Alibaba. JD launched in 2010. They currently have a market capitalization of 58 billion, and they currently have a PE ratio of 288. Since its IPO 6 years ago, it has been able to grow revenue very, very quickly. Revenue has grown from 21 billion to 360 billion in just 6 years. However, they are not yet a profitable business. Because we only have the financials from the last 6 years for this company, and because it's not able to make a profit yet, it means that this isn't going to be an investment grade company. If you are going to invest in stocks that are really high growth like this, no track record but have been performing really well, and maybe you really like the idea behind the business, make sure that you're only allocating a small proportion of your portfolio to stocks like this. And I like to call that a speculative position. And that's because we really don't have enough data, and the data is not consistent enough for us to be able to accurately predict where this company is going to go. So we don't really know where it's going to go. It makes it really risky, so you want to minimize that risk by keeping it as a small proportion of your portfolio. Stock number 5 today is Synchrony Financial, and they were formerly GE Capital's retail finance business, and they are actually the largest provider of private label credit cards in the United States. They have a market capitalization of 26 billion, a PE ratio of just 13, and they pay a dividend of just under 2%. Because this was formerly a part of GE, we only have financial data for this specific business for the last 6 years, and straight away that means that we just don't have enough data. We need at least 10 years of data for us to be able to predict where a company is going based off the growth of those numbers. I really like the analogy that Warren Buffett uses so often. And think of stock picking as if you're playing baseball, but there's no strikes. So you don't have to swing. You can just stand there on the plate and take ball after ball being thrown at you and just wait and wait and wait and just wait until you get one that is perfect. It's positioned perfectly so that you can hit it and hit a home run. You don't have to hit every single shot, or you don't have to hit every second shot. And it's the same with stocks. There are going to be a vast amount of great companies that just don't look great, but then they end up performing really well. And companies that are really young that turn out to be huge companies like Apple or Microsoft. But the thing is, you don't have to invest in these companies, and you can just wait until you find a company that has perfect numbers. That means it's going to be really predictable, easily predictable over the next 10 years. Wait till it's on discount and buy it. And that's the kind of stocks I'm looking for. And it's why as soon as I see that we don't have enough numbers of track record, or the numbers are all over the place, it immediately puts me off, because I know that there are other companies out there that I can invest in that I will be sure to make my profits on. So that brings us to the last stock of today, and also the last stock that I thought looked very interesting and that I had a bit of a further investigation into, and this is Canadian National Railway. This is a massive railway company in Canada that has tracks all over Canada and also through Chicago to the Gulf of Mexico. In 2016, Canadian Railway delivered 5.2 million carloads over its almost 20,000 miles of railway track. They currently have a market capitalization of 60 billion, a PE ratio of 15, and they pay out a dividend of just under 2%. Having a look at the growth of these numbers over the past 9 years, we can see that they're very good. Sales growth is a little bit slow, but it's been improving each and every year and has been able to maintain a stable growth rate between about 5 and 8.5%. Earnings per share growth has been amazing, growing each and every year, and long-term growth is just over 15%, well over our 10% requirement. Equity growth has been slow in the past, but improving every single year again, and free cash flow has been very strong over the 9 years and over the more recent years. Based purely on these numbers, I estimate that the stock is valued at about $70 per share, which isn't far from its current stock price, which is about $80 per share. However, when we calculate value, we then need to discount it by 50% to ensure that we allow for errors in our valuation and to be 100% sure that we're going to get our 15% returns each year. So if I value the stock at about $70, it means that I'd only be willing to pay about $35 to $40 before I start making an investment. However, that being said, if we come and have a look at the value matrix, we can see that the downside for this stock is very low. Even if they were only able to grow at 2.7% each year for 10 years, and they had a PE ratio of 12 in 10 years' time, we would still get a positive return, even though it's very small and basically zero. It means that if the worst case scenario happens and it grows at about 2 to 3%, it means that we haven't made a loss on this stock. However, the reason that the margin of safety price is 35 is because if we're buying at the current stock price, the expected returns are going to be somewhere between 11 and 15%, which is not high enough for us to have a significant margin of safety. If it misses that by 50% and it only does 5% growth per year for 10 years, we're only going to get between 3 and 9 and 10%, which is really not a strong enough return for just falling short of the expectation. So I find this one very interesting. I'll be having a deeper look into this stock and reading through the annual reports and learning a little bit more about it, because I think it's a very interesting stock with a very sustainable moat in terms of railway track that's already set up across Canada and the United States. However, at the current price, I think it's just a little bit too high for me to be able to get a very significant 50% margin of safety and be able to ensure that I'm going to make 15+% returns on this stock. So that's all for today, guys. I hope you enjoyed this one. If for some reason you hadn't seen part 1, make sure you go check it out. I'll leave a link to it down in the description below. If you did enjoy this video, make sure you show me some love and hit subscribe, hit that like button, and let me know your thoughts down in the comments below. I love reading through those comments and replying to each and every one of you. I've been getting a lot more stock analysis requests, which is really great. So I've been adding to my list, and I'm going to be getting to a lot of those over the next few weeks. Also, keep an eye out on Instagram. I will be posting a video on Instagram TV in the next week to keep that going, because I want to post on YouTube as well as Instagram TV as regularly as I can. But for now, I hope you guys have a great day, and I'll see you later in the week.